Most people think regulation means the government creating unnecessary rules for businesses. That is only one side of the story. Regulation means the government creates and enforces rules that control how individuals, businesses, and industries operate. Deregulation means reducing, simplifying, or removing some of those rules. In simple words, the debate asks, how much control should the government have over the market? Think about the food industry. Restaurants must follow rules about hygiene, food storage, allergens, employee safety, and labeling. These rules increase costs, but without them, some businesses may cut corners, hide risks, or operate in unsafe conditions. The customer cannot inspect the kitchen before ordering. The business knows how the food was prepared. The customer does not. This information gap is one reason regulation exists. We use the same logic in everyday life. A road without speed limits, traffic lights, driving licenses, or safety standards may offer more freedom, but it would also be far more dangerous. Rules restrict some behavior, but they make the wider system safer and more predictable. Regulation exists in almost every major sector. Banks face financial rules. Airlines face safety standards. Factories face environmental controls. Employers face labor laws. Hospitals face medical regulations. Technology companies face privacy and data rules. The first purpose of regulation is consumer protection. Businesses may mislead customers, hide risks, sell unsafe products, or use unfair contracts. Regulation can require clear prices, truthful advertising, product safety, and accurate information. The second purpose is worker protection. Labor rules may establish minimum wages, safety requirements, working hour limits, and protection against discrimination. The third purpose is environmental protection. A company may increase profit by polluting rivers or damaging the environment. The company receives the profit, but society pays the cost. Regulation forces businesses to consider the harm they may otherwise pass to the public. The fourth purpose is market stability. Banks handle savings and credit across the economy. If they take excessive risks and collapse, the damage can spread far beyond the bank itself. Financial regulation aims to reduce that risk. The fifth purpose is fair competition. Competition laws try to prevent monopolies, price fixing, and powerful companies from blocking smaller competitors. But here's the catch. Regulation can become excessive. Businesses may face endless forms, multiple licenses, long approval delays, and outdated rules. This is where deregulation enters the debate. Deregulation aims to remove rules that are unnecessary, inefficient, or harmful to competition. It may reduce costs, encourage investment, support innovation, and make it easier for new businesses to enter the market. For example, if a small delivery company needs 20 approvals and months of waiting, only large companies may be able to survive. Removing unnecessary requirements may increase competition and lower prices. Too many rules can protect established companies instead of protecting the public. Large firms can afford lawyers and compliance teams. Small businesses often cannot. Regulation can also slow innovation. Technology changes faster than government. Rules designed for traditional taxis may not fit app-based transport. Rules designed for physical banks may not fit digital finance. But deregulation is not automatically beneficial. Removing rules may lower costs, but it may also remove important protections. A factory may become cheaper because environmental standards were weakened. A bank may offer more loans because risk controls were reduced. A company may earn more because safety requirements disappeared. The benefits may appear quickly. Lower prices, faster approvals, more investment. The risks may stay hidden until something fails. A workplace accident, a polluted river, a financial collapse, a defective product, a major data breach. One important concept is market failure. Market failure happens when normal competition does not create a fair or efficient result. Pollution is one example. A factory produces cheaply because it does not pay the full cost of the damage it creates. Another example is information imbalance. A bank knows more about a financial product than the customer. A doctor knows more than the patient. A manufacturer knows more about ingredients than the buyer. Regulation may require disclosures, qualifications, warnings, and safety standards. Natural monopolies create another problem. Water networks, electricity grids, and railway infrastructure require huge investment. It may be inefficient to build several competing systems, but if one company controls everything, it may charge high prices or provide poor service. Government may regulate prices, access, and quality. However, regulation itself can also fail. Officials may not understand the industry. Rules may create unintended consequences. Agencies may lack staff or expertise. Political pressure may influence decisions. Sometimes the industry begins influencing the regulator. This is called regulatory capture. Regulatory capture happens when an agency meant to protect the public begins serving the industry it regulates. That is why regulation must be independent, transparent, evidence-based, and properly enforced. A strong law means little if inspectors accept bribes or ignore violations. Sometimes the real problem is not the absence of regulation, it is the absence of enforcement. Every regulation also creates a cost. Businesses may need to hire staff, change equipment, train workers, or submit reports. These costs may be justified if serious harm is prevented, but governments should still ask whether the benefit is greater than the burden. Good regulation should be proportionate. High-risk industries should face stronger controls. Low-risk businesses should not face the same burden as banks, hospitals, or nuclear power stations. Governments can also use risk-based regulation. Businesses with strong records may receive fewer inspections. Companies with repeated failures may face greater scrutiny. Technology can improve regulation by automating licenses, tracking compliance, and identifying suspicious behavior. But technology also creates new challenges. Artificial intelligence, digital currencies, online platforms, facial recognition, and data systems can develop faster than laws. Governments may use regulatory sandboxes, allowing companies to test new products under controlled conditions. This creates a middle path between complete freedom and heavy control. Another debate is self-regulation. Businesses may create their own standards because they understand the industry better. But self-regulation has a clear weakness. Companies may hesitate to punish themselves. That is why self-regulation may support government oversight, but it may not be enough in high-risk sectors. Deregulation should also be separated from simplification. Removing duplicate forms or combining licenses is not the same as removing safety protections. The smartest policy is not always more regulation or less regulation. It is better regulation. But here is the brutal truth. Businesses may call every rule a burden. Governments may claim every new rule protects the public. Both can be misleading. The real questions are, what problem is the rule solving? What harm is it preventing? What does it cost? Who benefits? Who carries the burden? Can it be enforced? And is there a better alternative? Regulation always creates trade-offs. Stricter environmental rules may improve health but increase costs. Higher minimum wages may raise income but pressure small businesses. Stricter banking rules may reduce risk but limit credit. Stronger privacy laws may protect citizens but increase the cost of digital services. That is why governments should review regulations regularly. Old rules may no longer work. New technology may create risks the law does not cover. A regulation may also produce unintended harm. Deregulation should be evaluated too. Did prices fall? Did competition increase? Did service quality improve? Were workers or consumers harmed? Did new risks appear? So regulation and deregulation are not simply a battle between government and business. They are about balancing freedom, safety, competition, innovation, and public responsibility. Too little regulation can lead to exploitation, instability, and harm. Too much regulation can create bureaucracy, higher costs, weaker competition, and slower innovation. At the Learning Studio, we will understand regulation and deregulation as tools of public policy. Because the real question is not only, should the government create more rules or remove them? It is, what risk are we trying to control? What protection is necessary? What burden does the rule create? And how do we know whether the system is working?